Who really owns the Federal Reserve and controls Seigniorage? The Federal Reserve System, often referred to as the Fed, is portrayed as the independent guardian of U.S. monetary stability. Yet behind its complex structure and technical jargon lies one of the most opaque and misunderstood institutions in modern history. The Fed doesn't just manage interest rates. It controls the creation of money in the most powerful economy on Earth. And with that control comes a little understood but immensely powerful concept: seigniorage, the profit from issuing currency. So who really owns the Fed? And who benefits from the trillions created out of thin air? The myth of independence. The Federal Reserve was created in 1913 through the Federal Reserve Act, passed during the Woodrow Wilson administration after years of lobbying by America's most powerful bankers, including J.P. Morgan, the Rockefellers, and Paul Warburg, who was directly tied to the European Rothschild banking dynasty. While the Fed is said to be a public-private hybrid, it is, in truth, far more private than public. The Board of Governors is appointed by the President and confirmed by the Senate. But the 12 regional Federal Reserve banks are owned by private commercial banks in their districts. These private banks hold stock in the Fed and receive guaranteed dividends annually. Despite having the word federal in its name, the Fed is not a government agency, and its decisions are not subject to executive approval or congressional oversight in practice. The Fed operates in the shadows, shielded by complexity and backed by law. 2. Seigniorage, the greatest legal scam in history. Seigniorage is the profit made by the issuer of currency. For a sovereign government, this means seigniorage equals face value of money, cost of printing. So when the Fed issues $100 and it costs only a few cents to print or create digitally, nearly $99.99 is pure profit. But it does not go to the people. Under a truly sovereign monetary system, this profit would belong to the U.S. Treasury, used to fund public goods and services. But under the current system, the Federal Reserve issues money by buying U.S. Treasury bonds from the government. The money is created out of thin air, digitally, and lent to the government with interest. That interest is then paid by taxpayers, essentially renting money that should be ours by right. In short, the U.S. government borrows its own currency from a private central bank and pays interest for the privilege. 3. Who profits from this arrangement? The true beneficiaries of this system are the owners of the member banks of the Federal Reserve. These are the same banks that dominate Wall Street and hold enormous global influence. J.P. Morgan Chase, Goldman Sachs, Citigroup, Bank of America, Morgan Stanley, Wells Fargo. Many of these banks trace their ownership back to a small group of powerful families who control financial institutions through layers of subsidiaries, trusts, and cross-holdings. Historically, names like Rothschilds, Europe, Global; Rockefellers, U.S., Oil, Finance; Warburgs, Germany, U.S. Schiffs, New York Banking; Lazards, France, Global Finance, appear repeatedly in the formation of central banking systems, not only in the U.S., but in the Bank of England, European Central Bank, and Bank of France. These families use their capital and influence to institutionalize private control over money creation, which continues to this day under the guise of independent central banking. 4. The cost to the public. This structure has real consequences. National debt spiral. The U.S. national debt exceeds $37 trillion, much of it owed to the very same banks that help issue the currency. Inflation as hidden tax. When the Fed prints money to stimulate the economy, it dilutes the value of all dollars, effectively taxing the poor and middle class while assets held by the rich inflate in value. Interest payments to private banks. A significant portion of the federal budget is used to pay interest on debt, much of which is created through the Fed Treasury scheme. Loss of sovereignty. Any government that doesn't control its own currency is not truly sovereign. Monetary policy is ultimately dictated by unelected central bankers, not the people or their representatives. The case for public money. Some economists and financial reformers argue that the U.S. government should reclaim the right to issue its own debt-free currency, as it did during specific historical periods. Greenbacks during the Lincoln era. United States notes before the full power was handed to the Fed in 1913. One Turkish finance professor, Artug Çetin, famously calculated that if the U.S. Treasury, not the Federal Reserve, received seigniorage profit, the U.S. could eliminate its national debt within 10 years, even while funding public projects. This would require monetary sovereignty, returning the issuance of money to a public, accountable institution like the U.S. Treasury, without borrowing from private banks. Conclusion: the money monarchy. The Federal Reserve is not just a central bank. It is a power structure, a mechanism of control, and the cornerstone of the modern financial empire. Through it, a small elite extracts wealth from nations, manipulates markets, and dictates the fate of billions. The Fed doesn't just print money. It prints power. Until the public demands transparency, accountability, and a return to true monetary sovereignty, the seigniorage racket will continue, and the illusion of democratic control over the economy will remain just that, an illusion.